I think the biggest shift was the consolidation that happened with the insurance carriers themselves from 25 or more carriers that were writing major medical employer-sponsored health care to 4 national carriers effectively. We really have a handful of options today, and that's it.
Thanks for tuning in to the Self-Funded with Spencer podcast. Let's go make healthcare better together.
I could walk into most any employer up and down the street and ask to quote their health insurance. And if they were up for it, I had a list of about 25 major health insurance carriers. Now, they weren't always going to quote, but I had insurance carriers that were available to quote. No network. You go to any doctor you want.
Right.
It was all reasonable and customary reimbursements. There were carriers that could be hot, as we called it, because they were aggressive in underwriting the right business. And there were carriers that had cooled off. It was a very competitive market. There were a lot of options.
25-ish markets to go to.
Yes.
Yeah.
And a lot of those names are still out. Insurance carrier names are still out there, but they're not writing health insurance. Prudential, Principal, Guardian, MetLife, Travelers.
So all those carriers were writing. What time frame was this?
Yeah. This would have been in the
80s or
80s into the mid 90s.
Okay.
Maybe to the late 90s.
So you've seen all of the massive consolidation in the market.
Yeah.
So those carriers that did they exit because they couldn't maintain profitability? They weren't competitive? Why do you think that some of them just voluntarily exited? Or did they sell their health business off instead?
Yeah, most of them sold, some merged, but the number one reason was the development of the PPO product where the carrier owned the network. There was a cycle to get to that, and the cycle was initially PPO networks were provider groups that banded together and presented preferred pricing. And over time, those provider networks went away or were acquired, and direct contracts were written by the Bucas with the providers.
Yeah.
And the preferred pricing was such that if you didn't have those kind of contracts, you couldn't compete. Keeping in mind the original PPO network structure had maybe on the low side 15% and on the high side maybe 25 to 30% of the providers in them. Today's quote-unquote PPO network has north of 93, 94% of all providers.
Yeah.
So
where's the preference there
exactly.
at that point? Yeah.
And what's the incentive for preferred pricing when everybody's in the network?
Yeah, and even when we do disruption reports, and I assume we're probably going, right? Yeah, so you look at disruption reports from one carrier network to the next, and there's 98, 99% overlap.
Exactly.
What are you actually getting at that point other than the brand or the logo that's on the card? And I'm sure we'll get deeply into the discounts and all that stuff. You and I were laughing over coffee. But John, why don't we introduce you real quick to the audience? Who are you? What do you do? Who do you work for? And all that good stuff.
Thanks, Spencer. By the way, it's great to be here. Thanks for having me on the show.
My pleasure.
On the cast. So I'm John Rutledge. I work for Marsh McLennan Agency, which is a large national broker, part of a larger international insurance broker. My role is I'm part of the national benefits team, and I head up our alternative funding and health captive leadership for our employee benefits space.
Yeah. And that's a new role, right? Correct? That's something that was created recently.
Yeah, the role was created January 1st of this year. Up until that time, I was a producer within our organization. I had my own book of business, and then migrated over to this role for January 1st.
And yeah, I'm sure you have some insight of what you can share, but do you have some of the reasoning as to why Marsh recognized this role was necessary and needed to be created?
That's a great question, and the answer is yes. When we look at what's happened in the employer health insurance marketplace, really it's been several years, but there's been a huge migration from fully insured employers to self-funded employers. My first full year in the industry was 1982.
Okay, I was born in 1982, just for some context.
All right, now I feel old. So in 1982, fewer than half. 42% of large employers with more than 500 employees, self-insured. Mm-hmm. The model was traditional fully insured. In fact, I handled a major national hotel chain, the Residence Inn.
I remember the Residence Inn.
as a Blue Cross rep, and this was before they were acquired by Marriott, and they were fully insured with several thousand employees. Well, today, fast forward, 43 years later, and more than 60%, in fact, we're approaching 70% of all employers self-insure in some form or fashion. And it's really accelerated the last several years. I think the Affordable Care Act has helped drive that. And as we've seen more employers, particularly in the small and middle market sector, self-insure, the options for self-funding and alternative funding, including group stop-loss captives, has really exploded. So MMA simply saw what was happening in the marketplace. The data suggests that employers are unhappy with the limited number of health insurance options that they tend to see. And so MMA said, look, we need somebody who can lead, set strategy, help keep their finger on the pulse of the market, share that back, and help our teams understand, how we can serve our clients in the self-funded, alternative funded, and captive space.
Well, and as we were talking over coffee too, there's an objectivity that's actually very helpful with a position like this, where your job is to understand the market, understand what's out there, but based on the unique circumstance of that individual employer or situation, make a recommendation or provide some guidance to your team. And you likened it, I really liked your analogy of, I need a captive, right? Is a captive right for me? And then your response was a vehicle right for you? Which vehicle, right? And depending on the person's needs, it's a family, it's a young guy, they need towing capacity. The answer is it depends, and let's tailor a vehicle specifically to your use case and not just say you need a vehicle, right? And I think I always refer to captives as a vehicle of self-funding, but that vehicle can be tailored to suit that particular employer.
Yeah, that's exactly right. And by the way, self-funding as well as captives are not going to be the right vehicles for every employer. There are employers that really should remain fully insured. But for those employers that self-funding is an option and captives can be an option, there really needs to be, as you said, an objective analysis to match the right captives and vendors and service providers to that particular employer, which can depend on what industry we're talking about, the size of the employer, the objectives that the employer has, what do they want to do with their health plan specifically.
Well, I'm glad you said that. And I do want to go back in time because you have 4 decades of experience, and I'd like to hit some big bullet points of some of the big changes you've seen. And I think we'll talk ACA as well. But there are situations where we would even look at a case. And obviously my job is to present and help sell Pareto. But we would look at a group and go, you know what, you probably are better off staying fully insured. Or maybe you have another option that's on the table. We just can't quite get there because of pricing or manuals or whatever. And I would never recommend that no group is ever fully insured. There are certain situations where the pricing is just too good or the risk profile is a little bit hairy. And so they're actually in a pool that better serves them, at least at this moment. And I think that's okay to say. What I would say, though, is I think there's exponentially more employers who have stayed fully insured for a multitude of reasons that are probably not in their best interest. And so my goal is to find those ones that are at least open to the idea and give them a vehicle, if you will, to get to a destination they're looking to get to. And we use the podcast platform more as that educational, the awareness piece of what I do. Having spent years working alongside healthcare leaders, brokers, and employers, I know how overwhelming healthcare can feel for our customers. We've all been there. Those renewal conversations that never seem to get easier. Rising pharmacy costs and medical costs, and no real transparency into where healthcare dollars are going. That's why I'm excited about Nomi Health. They're not just fixing the old system. They've rebuilt self-funded benefits from the ground up. With Nomi's network, you can offer something truly different. No copays, no deductibles, zero out-of-pocket costs when members see a provider. It's the kind of benefit that makes everyone ask, why hasn't healthcare always worked this way? Ready to bring your clients something different? Visit nomihealth.com and see how Nomi is rebuilding healthcare, one employer and one community at a time. But let's go back in time, because I know you said we started off the podcast talking about the $100 deductible plans and 25 carriers that are out there. Talk to me about some of the big shifts, John, that you've noticed over those years.
Well, I think the biggest shift was the consolidation that happened with the insurance carriers themselves from 25 or more carriers that were writing major medical employer-sponsored health care to 4 national carriers effectively. Now, there's certainly HMOs and local health plans in some markets.
Sure.
But we really have a handful of options today, and that's it. And that occurred because largely the PPO, the Preferred Provider Organization, developed as a response to managed care, HMOs, and a way to get preferred pricing and trying to manage the cost of health care. Initially, the percentage of healthcare providers that participated in those PPO organizations was pretty small, less than 30%. And over time, what happened was a handful of insurance carriers said, we're not going to rent or use this PPO, we're going to build our own. We're going to have our own contracts with providers, and we're going to leverage our entire book of business to get the best pricing we can with those providers. And what happened was insurance carriers that didn't take that course, that didn't own and build their own networks and contracts with providers, ended up either selling their blocks of business or in some cases selling their whole company, or just getting out of the health insurance business because they can't compete. The reality is the single biggest cost component to health insurance is cost of claims.
Yep.
And if you, as an insurance carrier, can have a better pricing arrangement, which means your claim cost is lower than a competitor, you're going to win.
Yeah.
So in the 90s, late 80s through the 90s, we saw this huge consolidation of insurance carriers happen, and competition, really kind of went away. And that was a huge shift for what the model had been prior to that.
Yeah.
Prior to then, the reimbursement method was what's called reasonable and customary, which meant you go to any doctor you want, the insurance company has a benchmark that they'll reimburse, and if your doctor's charge happens to be above the benchmark, it's between you and the doctor. The benchmark was always pretty high and covered typically 90% of all the hospital and doctor charges out there. But that has changed. That the whole paradigm shifted.
Was the paradigm shift mostly from the Affordable Care Act? I mean, even you want to contrast life before the ACA and then life following the ACA, it'd probably be good to understand, because I'll admit I started in this business right as the ACA was rolling out, so I had no context for what it looked like before.
Yeah, by the time the ACA was really written into law, and even before, this consolidation had already happened. So by the time President Obama signed the ACA in 2010, we had a consolidated health insurance industry. Now the ACA is another watershed moment because the ACA, among other things, really dictates a level of coverage that each health insurance carrier must not only offer, but they pretty much match it based on what's called the small employer mandate.
Okay.
On top of that, health insurance carriers, and I'm talking about fully insured business,
yes,
are required to cover certain state-mandated benefits, as I think most of us knows. So if you're an employer in Texas and you buy a fully insured contract for your employees in Texas, Texas law says these benefits must be included. ACA says these benefits must be included. And so whether you're insurance company A, B, or C, doesn't matter because you have to abide by those two major pieces of law. So the ACA standardized coverage for the traditional and major health insurance carriers. It also locks in their operating margins because they're required to manage their books of business to 80 or 85% loss ratios, depending on whether we're talking about small group or large group. So it's kind of created this situation where no matter whether you're Blue Cross, United, Cigna, or Aetna, it's almost like chocolate, vanilla, strawberry.
Yeah, you're buying a different logo, but I'm not exactly sure what you're getting in terms of a difference in product. I mean, the way you're describing it, at least, and I'm sure there are nuanced differences from one carrier to the next, but ultimately you're effectively buying logos or a network. And we've talked about, and I think we'll expound upon the differences of networks and what that really means, but you're not really getting a different product per se. And so you can do, I think you described it as a teeter-totter, right? You teeter-totter between carriers one year to the next, but you're not really solving the problem in and of itself.
You're really not. And the teeter-totter analogy is one that I think we see in a lot of markets where even though we've got 4 national carriers, and again, certain markets have their own health plans, but in most markets, there are really just a couple of options that are active in health insurance for employers. And so employers tend to kind of rock back and forth between a couple of options. The other analogy I like to use to describe the current health insurance situation, employer health insurance situation, is I call it the fully insured box or the Buca Box.
The Buca Box, yeah.
And it's exactly what you said. You're really getting the same thing, just the logo is different. And the way I describe the box is it comes in different sizes. You can buy different deductibles, have different copays, and so forth within region. It comes in different shapes. There's a PPO box shape. There's the EPO, point of service, HMO shape, and there's different colors. Blue being the most dominant for Blue Cross Blue Shield. But when you look inside that box, what you get is pretty much the same.
Well, and I'd almost argue you probably don't get to look in the box most often as well. And what I mean by that is the so opaque nature of the contracts that are between that carrier and those providers and what makes up that particular network. And that's that laughable subject of discounts, right? And this argument that I have the best discounts, so-and-so has the best discounts. But my argument always back to that is, well, what is the discount off of? And do you have any idea discounts off what? Because if somebody advertises a huge sale and we've got 30% off couches, but they raise the price of the couch before they discount that, or the one across the street doesn't have a sale at all, but their prices are lower than the sale price over here, then does the discount actually matter at all? And I would argue it really doesn't matter at that point.
And I don't disagree with you. I do think that we're still kind of on the beginning stages of more and more price transparency. The Consolidated Appropriations Act requires providers to disclose pricing. It's really not been enforced, and most providers have been very slow to post their pricing. But as providers do disclose what their pricing is, it's going to give buyers, particularly those that are self-funded and don't have to buy the network, from the Buca Box, it'll give our employers an opportunity to identify what providers they really want to have within their health plan.
Yeah, absolutely. And so over the course of time, you talked somewhat about the changes in the industry of itself. What about the demands of a broker or even a consultant today versus what it might have been 20, 25 years ago?
Well, it's hugely different. Just the fact that, 30, 40, 25 years ago or more, the standard was a $100 deductible major medical plan.
It's crazy to think about.
And today, we've seen more and more employers, as I said, self-fund. There are, legislative and compliance issues that have complicated things, not just the Affordable Care Act. We've seen the passage of, HIPAA, COBRA. There have been a lot of laws that have impacted the health insurance industry. So the broker has to really understand all these. And frankly, in the last few years, we've seen more competition begin to develop from startup health plans.
Yeah.
There have been more stop-loss carriers enter the marketplace for those who are self-funded, more captives. And frankly, a broker has a challenge keeping up with everything that's going on. So it's hugely different.
Well, I was telling you in the elevator up here, I almost don't envy the position you guys are in. And so I've never sat in your seat as a producer or consultant, although I have worked at a brokerage before as an analyst. But I don't envy the position consultants find themselves in these days, which is you are tasked with almost an impossible task, which is to know the entire marketplace and know it better even than maybe every single one of your clients who might be out there on their own investigating solutions for you. And then it almost becomes an issue where they bring up the idea of a captive to their producer and they feel like their producer or their broker wasn't doing a good job of canvassing the market. But the reality is they might not be aware that there are thousands of solutions you might have to potentially parse, and there's new ones entering the market every single day. So it is literally impossible to keep up with everything, right? So I don't envy the position that puts you in, which is you have a relationship, right, that you have to keep and maintain. You also have to continually look ahead of what solutions might be available for that particular employer. Then you have to do it dozens and dozens of times based on your block. And that's very difficult to do. The demands of a consultant today, if I use that term instead of broker, are exponential versus what a broker used to do, which was just shop different carriers and get you the best price, right?
ClaimDoc is a medical claim auditing and member advocacy company. We provide fiduciary services to employer-sponsored benefit plans and allowing them to create an environment where we ensure that the benefit plans are being charged on a fair and reasonable basis.
My business is basically people, and it become a real simple transition. We thought it was going to be far more complex. I've saved, we'll say, hundreds of thousands of dollars. I could not say enough about ClaimDoc.
You're exactly right. And you couple that with the fact that, in order to compete as a broker, you need support in the compliance area, communications, technology. Our firm, along with other firms, have units within us that specialize in human resources technology. For example, clinical care and management, data analytics, and all of these demands, do kind of bear on you as a specialist, and it's really tough.
Yeah, and that comes back down to the primary motivation for this podcast. I think a big part of your role as well is educating a marketplace. And so you have new young producers coming into the business that don't have the experience, but they also don't have the legacy of training, and they don't have the legacy of, we used to go to Blue Cross all the time, or they're almost a blank canvas in a way. But that means they need to be educated. There is somewhat a lack of formal education in the consultant space. I mean, why do you think things like group school have kind of gone away in the modern times?
Well, a big part of why the traditional group school has gone away is we have so fewer carriers today.
Okay.
And again, the training for new group reps is focused on what that particular product set is for the carrier. When I was first became a broker, I had 8 years of carrier experience behind me, and I'd been through a group school, but there were all these other, maybe 15, 20, 25 carriers that were also producing sales reps that went through group school. So the broker industry had a pool of people coming into it that had the technical knowledge. We just don't have the numbers today because we don't have the number of carriers that are doing it. So we're hiring people who are great at relationships and great at marketing and sales, and then we're tasked with teaching them ourselves the technical information about employee benefits.
Yep.
So we've got educational tracks that we've built internally, and I'm sure other large brokers are doing the same thing.
Yep. And I'm of the mindset that a less educated buyer is more likely to defer to what they know or familiar with, which is the Bucas of the world and staying fully insured. I also believe that the more educated the populace is, and employers are especially, the more likely they are to be open to alternative solutions. Like your job is to help find those. And I'll use a term that your counterpart, Travis Sarton in the Dallas office, he was on the show a couple years ago. He said he learned by darkening doorways. And so what he meant by that is just knocking on some senior leader's door and asking a question, or, hey, can you teach me how a spec works or whatever? And that's great. That's fine. That's a great way to learn under a mentor, but it's also difficult to scale that type of education one by one. And so I think our industry at large would benefit from more formal, broad-based education about this stuff.
Well, that's a big part of my job. And like Travis, I have found not only did I darken people's doorways, but every time we had a carrier rep show up and want to do a lunch and learn or something, I did all I could to make myself available to learn from our insurance carrier partners. You have to learn somehow. So you take every
that's a
avenue.
really good way to do it, by the way. So I used to sell stop loss for Sun Life as an example. One of the easiest ways for me to get into an agency I was trying to work with is just offer up self-funded education. Say, I will come in and teach this stuff. No obligation. I'll talk about what Sun does briefly, but this is not a Sun Life commercial or a Pareto commercial. This is what is self-funding. Because my bet was if I help build them up and educate them objectively, they're more likely when they do have a need or they have a question, they'll come to me, or they'll associate the training with what I offer. And maybe in a jump ball situation, they're more likely to recommend me versus a competitor. But it really was a give first kind of mentality. And I do think long term that obviously I reaped benefits from that. One thing I do want to talk about in your time as a producer is you developed kind of a unique solution for temporary staffing agencies, which was what you were doing just prior, right, to this new role. So tell me, what were the problems in that type of industry, and then how did you go about solving what was unique to them?
Well, the problems really stem from the fact that temporary staffing and other industries traditionally have not provided health benefits to large segments of their population because they simply didn't need to.
Okay.
Plus, it's a very tight margin industry. So whether it's temporary staffing, hospitality, hotels, janitorial services, these are a lot of lower wage, high turnover industries. And when the Affordable Care Act was written into law, whether you were labeled a temporary employee or a permanent employee really didn't matter. Those were not classes, in quotation marks, that mattered to the Affordable Care Act. It really mattered whether, are you working enough hours to be full-time or not?
Yeah.
And if you are, then the law says benefits have to be offered. Well, the traditional health insurance carriers out there are not required, to write every employer.
Right.
So we suspected going into the implementation of the Affordable Care Act that we would have a challenge getting the traditional carriers to write staffing.
Okay.
We did our best to educate them at the corporate level and try to convince them to write staffing, and we had limited success. But ultimately, what we decided to do was we went to certain TPAs, stop-loss carriers, to build level-funded and other alternatively funded ACA-compliant products. There were a handful of people around the country that conceived, MEC plans. So I was part of that group. And we built a captive program just for temporary staffing. So we created health insurance products that would keep our clients compliant with the Affordable Care Act. And they were all self-funded or partially self-funded.
Okay. Yeah, and so you're right about that. I mean, as I see like traveling nurses as a category that's difficult sometimes to get stop loss pricing for. Since you have so much experience there, is there something about the risk profile in and of itself of those type of industries? Is there adverse selection? What causes trepidation with a carrier?
Well, the biggest trepidation initially was there was a belief that this population had never had health benefits offered, and there must exist some pent-up demand, and that as soon as health care coverage was offered to them, everybody was going to sign up and blow up the system with claims. That was the initial problem. But they also had problems, underwriters had problems with high turnover, seeing there's not a stable, predictable base, and there was a concern that people would come on the plan and use the benefits and get off again, driving claims up. The most interesting part of that is, and now that we're going on 10 years of actual experience, because really, even though the Affordable Care Act was passed in 2010, many employers didn't have to comply until 2014, 2015. What we've actually seen is that population really tends to be very low utilizers of health benefits. So it's turned out to be a pretty good risk. Yeah.
So they were fearing adverse selection, and that pent up demand didn't actually materialize. Yeah. So are you seeing more of a lean in from carriers today willing to write that type of business then?
No.
Okay. So they still have that residual concern that they had originally.
Yeah. We've tried to educate some of them, and I'm not saying they can't be educated, but the traditional underwriting thought and process prevails, and that is we need a stable population so that we have more predictability. And by the way, carriers still have their own participation requirements and their own contribution requirements, which make it very challenging for those industries to abide by. So we still don't see most of those industries being appealing to the major carriers.
So when did captives sort of enter into your worldview as a possible solution in that mid-size segment? When did you start really working with captives?
Yeah, my initial focus on captives was many years ago as a stop-loss alternative for larger clients.
Okay.
But when we built this captive model for the staffing industry, and we really got some experience really building it and seeing how it operated and how employers responded to it, it became pretty obvious that, hey, this is a pretty good model in certain situations. And with the increasing cost for healthcare, particularly fully insured numbers going up as they've gone up, self-funding in general is an obvious alternative to look at. But we've had a very volatile stop-loss market.
Yeah.
And we see, captives being a much more stable option for the middle market.
And it's safe to say, and to talk about the growth of not just the captive space specifically, but at large, an alternative risk model. So if I wanted to find that for somebody that hasn't heard, that's a level funded product, that's traditional self-funding, that may be a captive, something that's an alternative risk model to our traditional fully insured, right? There's a McKinsey study that came out 4 or 6 weeks ago, somewhere around there, that said by 2030, there's going to be approximately 12 million more member lives covered in an alternative model. They did cite captives as one of the larger segments of that. But I think you're seeing a shift, and you're even seeing it in some of the data where most recently, I think the fully insured market for 2024 actually crested and lost a little bit of market share, 2.5%, 3%, somewhere in that range. So will that trend continue? I actually do think it probably will. So being at this moment in time where we're at perhaps more of an inflection point, especially down market, that excites me, right? But then for you, your job is to go, okay, well, what is the right fit? Which solution is right for you?
Pareto Health is the largest benefits captive in the United States. With nearly 3,000 captive members, 1.3 billion of stop-loss premium in force, and almost 1 million covered lives, no other benefits captive comes close to Pareto Health's scale. But it's not just about the numbers. Pareto Health is a mission-driven organization, and that mission has 2 distinct parts. Number 1, to make self-insurance simple and more accessible for small to mid-sized employers. And number 2, to arm them with the most powerful cost management tools on the market. So if you're an employer frustrated with your healthcare outcomes, or you're a benefits consultant looking for an alternative to the status quo, it's time to consider Pareto Health. Pareto Health, where employers come to do self-insurance right, to do it easily, and to do it at scale.
So if you were to categorize those, and maybe I'll ask you to put some guardrails on, when you think about a level funded product, right? Could be a carrier driven, could be an unbundled version of that with a new entrant. When does level funding make sense for an employer?
Well, I think level funding can be a good stepping stone from fully insured into self-funded because it looks a lot like fully insured. And what I mean by that is the employer is really paying a single premium amount. Behind the scenes, the dollars are accounted for differently, and there's an opportunity if the claim fund, the dollars that go into the claim bucket, have a surplus, then the employer can benefit from that. So I think a lot of employers that are coming from fully insured, particularly on the small and mid-size, see level funded as kind of a way to dip their toe into
That's
it.
fair. Yeah.
And without taking on as much risk.
And are there constraints that you don't like, though? Because, I mean, I always think in terms of trade-offs. I was having a conversation yesterday about trade-offs from a 12-18 on ag to a 12-12 and what that'll mean in the following year. And so I think about trade-offs, and you have to go in eyes open, I think, as a buyer and understand what those trade-offs are, and then you decide if you want to accept them. So when you do talk about a level funded solution, what trade-offs do you think that employer has to take on?
Well, I think the employer has to be willing to understand that if they have good experience and their claims are below expected, they're not going to benefit from the cash flow. In a traditional self-funded arrangement, you get immediate benefit financially from good claims experience. B, you're limited in the financial benefits you get in a level funded plan. Most of those contracts require you to renew, and then you get a credit towards the administrative side.
Yep.
So you're not really getting immediate.
You're not realizing your own surplus.
You're really not
fully, right?
You're really not.
That is usually the one that I dislike the most, right? Yeah. Is the fact that you're going to take some of my surplus and set aside the fact you have to run exceedingly well. I mean, the loss ratios have to be really low for that surplus to even come into play. And then you have to split it. And then you have to, like you said, renew and get a credit. And so that it really feels like you're withholding some of the employer's money that should be theirs. And so that typically is what I view as the biggest trade-off, or constraint, if you want to call it that. But that's okay too. There are certain situations where, hey, give me something relatively easy that looks and feels exactly like I have today, might have a little bit of upside, and I'm okay with that for a couple years. And maybe I do have the plan to transition out of it at some point, but I understand what I'm doing or trying to achieve here.
Yeah, exactly. I think it can be a good option, again, either as a transition or for the employer that's just not ready to take on the level of risk or is still trying to wrap their head around all the mechanics of self-funding. In some cases, it's just it reduces their administrative burden internally as compared to a traditional self-funded model.
Yeah, and you almost have to compel employers these days to realize they're in the healthcare business whether they like it or not, right? Usually the common trope is that it's the second biggest line item on their P&L outside of payroll, and sometimes if they're heavy in manufacturing, maybe there's steel or something that's more expensive. But realistically, this is a huge line item for them of expenditure. And so whether you like it or not, and whether you like employer-sponsored healthcare or not, the reality is this is the system we have. And so I think you need to scrutinize this line item just like you would in any other part of your business. So if and when, so we categorize relatively small, I presume, mostly coming off fully insured into the level funded product. Go forward then is like, when is maybe a captive introduced? And maybe we even define what are some differences in captives that are out there as well.
So I think a captive can be a solution for stop loss in some situation. I mentioned earlier, we're in kind of a volatile stop loss market.
Yeah.
And we've seen most group captives, frankly, outperform the traditional stop loss market. And I think a lot of that is because the employers that tend to be joining captives are engaged. They want to manage their healthcare risk, which I think is really an ideal element of an employer who could be a candidate for a captive.
Yeah.
If an employer wants to take ownership of managing the health risk, be more engaged, they're effectively being voted on the island with other employers that have like minds.
Yeah.
So that brings stability, for one thing, in the stop loss market. It tends to bring lower trend overall. But there are differences between captives. There are captives that are purely stop-loss captives, and there are captives on the opposite end of the scale that are marketing themselves as, look, we have a packaged set of vendors and point solutions that you must use, that they believe in, and then there's everything kind of in between.
Yep.
There are captives that require capital buy-in. There are captives that don't. There are captives who have a dividend sharing policy of pro rata, meaning whatever percentage of premium the employer contributes to the captive, that's the percentage of dividend you get. There are other captives that say, no, we share dividends back based on each employer's own loss experience. There are some captives that only work if you're coming from fully insured. You're not eligible if you're already fully insured. There are other captives that say, no, you have to have been self-funded for at least 2 or 3 years to get into this captive.
Yeah.
So again, it kind of gets back to the vehicle analogy we talked about earlier. I'm often asked, what are the best captives? My answer is, what are the best vehicles? Is kind of a similar question.
Yeah. Well, we use the adage, if you've seen one captive, you've seen one captive. And that actually is true. I don't know the total number of captive managers that exist today. And then a lot of captive managers have, dozens of cells that are unique or specific to an industry. So there's so much variability. So it's almost inappropriate to talk about captives as if they're one singular thing. I think the thing that just defines them is group purchasing power. Some of them or most of them have a community feel, which you mentioned earlier. There's an intentionality of coming into a risk pool. And the design is, or the idea behind it is, more scale equals more predictability, more buying power, things like that. But beyond those features, there's almost infinite variability, right? And so it becomes difficult then, I think, for you or even a buyer to go, well, which one is right for me, right? How do I even know? And then how do I not confuse myself by having a dozen options that are all different presented to me as well, where now I just go, I have no idea what's different between these 10 or 12. So I'm just going to stay with what I know and stay level funded or fully insured. And so I think it's incumbent upon us in this space is to not sell confusion, not get too complicated in the way that you tell the story. Otherwise, you're going to deter a buyer from saying yes. I want to go back to something, John, if you don't mind. You said there's more volatility in stop loss today. It kind of explain that, and where do you think that's coming from?
Well, it's coming from the overall increase in healthcare costs, but particularly the increase in really large claims, $1 million and multi-million-dollar claims. Several insurance companies since the first of the year have made industry publication headlines talking about the losses that their stop loss books are taking, and pointing out the number of mega claims that's happening. Stop loss, I think, has become commoditized. I mean, there's a large number of insurers out there that write stop loss. It tends to be manually rated, mostly a pool product for those carriers. And as stop loss claims increase, loss ratios increase, rates have to go up. And I think what we're seeing in the captive space, captive is a subset of the stop loss market.
Yes.
If you have buyers who are entering captives and more actively engaged in managing their health risk, ultimately you're going to create a more appealing risk pool in the captive space than you do the traditional stop loss market. So, I was at a captive conference recently where a particular captive, I'm not going to mention who,
that's okay,
said that their $1 million plus claims actually have gone down. And they believe that is because of the fact that they're attracting employers who want to be engaged.
Yeah. What I do think is happening, and you mentioned this over coffee, is there's a kind of a selection bias into these alternative funding products, and perhaps some of the best risk pool or profiles are moving out of the fully insured pool. And if captives are subject to a death spiral, just like I would presume a fully insured carrier could potentially be as well, which means your good risk keeps leaving over time because of pricing or other reasons, and you're left with the average to poor risk maintained in the pool. The death spiral is, well, that keeps happening, and now you're left with just the bad risk, and it's destabilized as a result. Do you think the fully insured market is seeing some of the deterioration of their risk pool as a result of that?
I fear that that's happening. I don't have hard and fast data, but there is anecdotal data that suggests multiple carriers are sending messages, hey, renewals are going to get tough. Be braced for that. We're hearing that message.
When I'm seeing it too, and I told you and showed you the poll over coffee, I have been hearing anecdotally, especially in Texas, that there's some very large average fully insured renewals, right? Anecdotal, so I'm trying to be very careful and fair here. Right. So I posted a poll on Monday just asking the question, and it was a poll on LinkedIn, and it had categories of ranges, like what is the average renewal for fully insured you're seeing in your market? Is it 0 to 12? I think it did 13 to 29, 30 to 40, or whatever it is. And about 75% of the responses so far, we've had nearly 500 responses, is somewhere between the 13 to 25% range is average for their market. What I was hearing is worse. And so it's a little myopic looking at Texas, but I'm hearing actually worse. And so I'm seeing the cracks, if you will, in that space, which again is further driving people to look for something different than fully insured. And if that continues, that erosion of that market share is also going to continue as well.
Exactly.
Yeah. And so then that leads to, if I'm looking at one more category, right? If we've looked at level funding, we've looked at captives, then define for me, when do you think a group outgrows the need for a captive? Is it purely based on size, or are there other reasons why they would just go traditionally self-funded instead?
Yeah, I think size can be a factor, but not by itself necessarily. I mean, I do think you can reach a size where the value proposition of a captive may be diminished. But certainly if you're above 1,000 lives, up to 3,000 lives, I think there could still be a role for a captive. But a lot of it, I think, has to do with the financial structure, the risk sharing specifics to do that. Certainly if an employer just has a mentality of, we want to go it alone. Mm-hmm. And there are employers out there that say, we learned as we were members of a captive for 5 or 6 years, but we have other ideas that we think are right, and we just want to do our own thing. And I think that's a good example of when it may be the right time, if you're large enough. But size is not the only contributor.
Chronic health issues, surprise out-of-network medical bills, inflated medical and prescription drug prices. These issues cost self-insured employers hundreds of millions of dollars every year. Add to this the rising cost of care and potential for waste across the life of a claim, and it's clear that self-insured employers need innovative solutions that lower their health plan spend. At Valence, we've done just that, developed innovation that shifts the current paradigm. A complete and integrated ecosystem solution driven by data, one that manages and simplifies the complexity of medical claim costs. It is through analyzing millions of data points that we enable employers to realize and fuel cost-saving solutions. Valence experts come prepared from day one, targeting the fraction of claims that will drive the majority of health plan costs. That is how our team lives the Valence promise, engaging early and often for smarter, better, faster healthcare.
All right, so your commentary, I agree with you around the size. Most people have in their brain, 1,000 lives is too big or 2,000 lives is too big. And I would say not necessarily, because some comes down to, well, what are you actually trying to get out of your risk protection?
Right.
What other tools are available for a captive, or is the community feel important? Is the education, all those things? But then it also comes down to what spec level is appropriate for that group as well. Some of this just comes down to pure mathematics. Whatever the captive structure is in the design, is there adequate premium within that captive layer to protect that risk? And if the answer is no, then eventually that group might outgrow the captive. But if the answer is yes, you might be 5,000 lives, but have chosen a $200,000 spec, and there's enough premium there, and the captive is still comfortable with it, you still want the value proposition at large, then that's a group that's probably going to stay. But naturally, the groups, as we get into the very large market and the jumbo market, not only do they probably not need a captive at that point, they may not even have stop loss, some of these really large employers. And I think we have to accept that there are guardrails or limitations for when a captive is and is not appropriate. And then there's size ranges, both really too small and really too big, when the better solution is something besides a captive instead. You said something earlier, John, I want to ask you kind of to double click on that, is that there's a commoditization of stop loss. And I would agree with you completely. Why, in your vantage point, why do you think that has happened over the last few years?
Well, I think two things have really contributed to it. First of all, since the ACA, the size of the stop loss market in the U.S. has grown fourfold.
Fourfold,
400%, which has been driven by more and more employers seeking to self-fund since the ACA.
Yep.
Now, we've also seen, along with that, more carriers get into the stop loss market. And frankly, I think we've got so many carriers and so many employers self-funding that it's created a more mature stop loss market that has driven it to a commoditization level. But at the same time, that's also given birth to more opportunities for pooling, risk sharing through captives as a subset of that stop loss market.
Yeah, I was just talking to a carrier friend the other day, and they're looking to get into the captive space. I obviously can't say who, but they're recognizing too that this is where the industry is shifting, and some of it is just going, man, we're losing groups all the time to a captive. We don't have a solution, so we probably should create one. But to me, that's just more of a recognition is this is where the popular innovation is happening. I haven't seen much innovation in just pure stop loss in my entire time being in here. I mean, Granular tried to do it with their deductible range cohorts, and it was a pretty novel idea, but ultimately I don't think that really panned out, and they just sold, I think, to Elevance or Anthem as a result. And I don't know if it was purely based on loss ratio or if it was just because the product that they were trying to do that was novel didn't really pan out, and therefore let's just go ahead and sell and capitalize on that. You still see consolidation, though. As many new entrants and MGUs come in the market, you still see consolidation on the other side as well. I'm glad the space is growing. I mean, it's something like $45 billion or something at this point, I think, is the number.
The numbers I've heard are bigger than that.
Even bigger than that, yeah. And in the time that I can recall, I remember when it was a $25 billion space and thinking, my God, that's a lot of money. Yeah. But it just continues to grow and grow and grow. That is a good thing. The downside, and I think, I'm going to be biased here, the spreadsheeting element of stop loss plays a role in that. As much as I understand centers of excellence, I think that also plays a role in that. GAs, general agents that market stop loss, their whole premise is we have access to 25 or 30 markets. And so they do treat stop loss as if it was interchangeable. And sometimes it is. And then sometimes when things go really wrong, it's not. And that's where I think the commoditization hurts the market, when you don't really understand the differences between contracts. And spreadsheeting, for what it's worth, I understand the reason it exists. But when you distill an insurance solution down to a couple of lines on a spreadsheet and ultimately a number, that really doesn't tell much of the story, which is where captives, I think, enter in and do a better job. And so let's flash forward, John, if you don't mind, and talk big picture. A couple of things I want to ask you is, first, what do you think our industry is in desperate need of at the moment?
The brokerage industry?
Yeah, so let's consider the market of employee benefits professionals, by extension, the employers that work with them. But what are we really needing to change at this present moment?
Well, I think we need two things. First is we need to elevate the technical knowledge that is needed to be able to grasp and communicate the more technical solutions like captives and very sophisticated self-funding solutions. Mm-hmm. And the second thing we need is we really need to pivot away from just focusing on that fully insured, and it's not just fully insured, but the traditional network-based health insurance option, because there are other options that are being built and delivered. And we've got to understand those. We've got, those can bring point solutions such as, cash pay, narrow networks, care navigation can play a huge role in this. And the major health insurance carriers are trying to incorporate some of those things into their solutions, which will help. But, it takes a long time to change course if you're a big ship.
Well, as seminal as the ACA was in the last decade or so, do you anticipate we might experience another really big marketplace shift like that, whether it's through legislation or otherwise?
Well, I don't have a crystal ball. And certainly when you inject politics into the situation, anything can happen. So, I don't know what's going to happen with the current administration, but,
our space has attention. I mean, it's pretty clear that what we're doing and where we operate has attention of politicians. Whether that's a good or bad thing remains to be seen. But there is scrutiny on our industry, especially in pharmacy at the moment. And so my hope is that we're going to get legislation one way or another. Whether or not it has the intended effect, who knows? But at least I know that this industry is being paid attention to quite a bit right now.
Well, it has to, because it represents such a huge piece of our economy.
Yeah. Well, and I'm going to ask you this. You don't have a crystal ball, but we've talked on networks a couple times now, the origination of a network and where we are in 2025. Do you envision a world where networks almost dissolve and are no longer part of the equation anymore?
Not in the near term.
Not in the near term.
I just think that the established network-based system is so big, so prevalent, and most buyers frankly know nothing else, but I can see an erosion of it over the next 5 years.
I see erosion, dilution of the value proposition, whatever you want to call it. Like we just described why those networks really don't mean a whole lot anymore. And you see everything from a reference-based pricing to narrow high-performance networks. Those things are popping up and gaining popularity, but not really becoming a majority of the market share, nor do I think they will ever be a majority of the market share. But can I ask your opinion on these solutions that are out there where people are building plans that have like a third tier and they're driving people to these narrow networks and waiving copays and deductibles? I mean, are you seeing that work?
I am seeing that work. And I think a lot of this, in terms of the migration towards those types of options, is somewhat generational.
Okay.
And what I mean by that is we see much less loyalty to the major insurance logos from buyers who are particularly under 40. And let's face it, if somebody is 30, 35 years old today, they're the future decision maker.
Yeah, absolutely.
And my generation, I happen to be a baby boomer, and Gen X. We're much more committed to the status quo as from a comfort level. But I do think these solutions that you described are, first of all, they're gaining footholds in certain areas, and I think that you're going to see them gain more of a following as we see more in the millennial generation decision makers and younger.
Yeah, they don't have the same affinity for those products. Or, I still see today, we drive in Texas, so I obviously see one carrier here has billboards all over the place where somebody's smiling next to their ID card, and they're still very effective marketing engines, don't get me wrong. But the affinity that's attached to that is, I think, eroding. And I think I really want employers to understand there's a difference in access in the health insurance they have. There's a difference in your health plan and health insurance. And there's certainly a difference in the logo and the carrier that's providing those things versus what you can actually do with a health plan if you're just willing to listen and to learn. But is there anything that's novel in your mind? I mean, you mentioned care navigation before, but are there other solution sets or point solutions or things that you're actually seeing move the needle, especially when it comes to claim savings itself?
Well, I think this gets back to something you and I talked about earlier, and that is, specialty care represents a huge part of our healthcare spend. And when you look at, if we rank the providers based on the charges within specialty care, there can be a 30% price differential from the first quartile to the third quartile. And the quality of care you get is not directly related to the price you're paying. So if we can find a way to steer more members to more cost-effective and less expensive providers, and think about it, if it's 30% less for that type of care, that's going to move the needle. So finding ways to use technology to do that through care navigation, deploying, I think, cash pay has a tremendous potential to help really solve this issue, because a lot of healthcare providers are analyzing the amount of overhead they have tied up in dealing with managed care and healthcare organizations that require pre-certification processes and claims and contract limits that they have to keep up with. And cash pay is very refreshing to a lot of providers.
Yeah, and so it's not out yet, but by the time your episode airs, it will be. I sat down with the COO, I believe, of Know Me Health, and he was talking about one particular hospital system they were working with. They had 2,500 people on staff that did billing and collections alone.
Yes.
So 2,500 people that are not doctors and are not clinicians, not providing care whatsoever. They're simply getting reimbursement and collecting payments, right? So that tells me there's probably 25% of that organization that's overhead going towards administration. And you want to eliminate administration altogether, don't get me wrong. But what cash pay does is dramatically reduce the dependency on administration in order to get paid.
Yes. And back to the prior point of trying to identify the most cost-effective providers, think of if we have the ability to take data and identify who those providers are, and then marry that to technology to be able to help an employer say, look, these are the providers you want your employees to go to. And if we're successful at getting employees to actually do that, I mean, yes, double-digit savings, which is what employers are really looking for.
Yeah, no, I don't think it's ridiculous to assume we probably have somewhere between 30 to 50% waste in the way that in the amount that we pay for healthcare in the United States. Set aside my strongly held belief that we have some of the highest quality care and innovation in the U.S., we're overpaying, and there's just absurd inefficiencies in the way that we pay. So the closer we can get to this is the cost and this is how much you pay, and you pay cash or an equivalent of cash for most healthcare interactions, the better off I think we're all going to be. But that comes down to accuracy of data, having access to pricing information, and then getting that into a member's hand in real time. So you or I, if we're just your average American that doesn't give a crap about what you and I are talking about, but they have to go to the doctor or they have to go to a specialist, that we make it very simple for them to go, okay, I should go here, whether that's through incentives or just clarity of price. I should go here and make it easy for them to schedule an appointment. If we can remove that friction element alone, I think that would dramatically improve the outcomes that we're seeing.
Yeah, the reality is in this country, we're pretty lousy healthcare consumers. We don't shop for healthcare the way we shop for electronics and vehicles and other things, and we're just not good at it. And we have a system that allows many healthcare costs or vendors to market directly to us. I mean, if you watch TV at night, like my wife and I are big TV watchers in the evening, the majority of the commercials are pharmacy, and they're very expensive drugs.
One or two countries in the entire world that allows direct-to-consumer advertising of pharmaceuticals. It's crazy.
and a huge percentage of the prescriptions that are written are because the patient walks in and requests a prescription.
Asks for it.
Yes.
But unbeknownst to that patient, they might be asking for a Skyrizi or a Stelara or something like that with a six-figure price tag.
Yes.
They just go, oh, well, it's supposed to help with my psoriasis or whatever, and I'm not even blaming them. Oftentimes, you'll find the physicians don't even know how much the drug is that they're prescribing. I mean, how broken of a model is that?
It is.
Yeah. All right. So, John, you are, leader of the healthcare world for a year. What else? What are you doing? Right. We touched on education. We touched on transparency or clarity in pricing. If you could wave a magic wand and have your vision of healthcare implemented, what are one or two things that you think you'd like to see?
Well, if I really had my way, I would create a system where employers have more skin in the game and we're more engaged, where providers had pure transparency of pricing. Frankly, I would love to see every healthcare provider have the same, whatever the lowest cost is, available to all payers. And I would like to see employees more engaged. So I would love to see a system where, for an employer to maximize and continue getting the best cost for health care, that they've got to get their employees engaged through health promotion, wellness. I'm a huge believer that happy, healthy employee is a more productive employee.
Absolutely.
I have grave concerns over the rise in obesity in our nation, particularly with our youth. And I think it's a ticking time bomb that we're on the verge of seeing explode, and we've got to figure out a way to address that. And I think having employers who are more engaged in helping their employees stay healthy is a big part of it. So if we can find a way to integrate those things into an employer health plan system, then I think we can really, change things for the better.
Yeah, and if we were all healthier, right, we would be having far different conversations about healthcare in the United States and the cost of healthcare. I mean, that is the fundamental driver behind most of it, even all the inefficiencies I just described. It's the necessity of care because of chronic illness and obesity, metabolic dysfunction, et cetera. Until we fix that, it's really, I don't want to use a foul term, but peeing in the wind here, a little bit in what we do. And that's beyond your and my control. And I think that's at a population level, people just need to figure this stuff out and to need to decide to be healthier. And so you and I, we can do our best on the risk side of the equation and do our best to help provide clarity how to pay and how to manage a health plan. I can't make people eat better. I can't make people healthier. That's up to them. So we've covered a lot of ground, John. I usually give you the last word of what you want to summarize the episode, or maybe a closing thought that you want to leave the audience with. And so the floor is yours. What do you want to say as we close the show?
Well, again, thank you for having me on. It's been a real pleasure. I think I'd like to close with kind of a message, two parts. One of it is to the benefit advisors out there, and one is to the employers. And to the benefit advisors, I would say keep learning and break the box. Get out of the box. Challenge the insurance carriers to do better, to do more. Come up with your ideas. Embrace as best you can point solutions and vendors that ask for appointments, that claim to have new ideas, and listen to what they say. Because we have to not only be aware of the products and the services that are available in this space, but we have to vet them and understand ourselves how they work so we can apply them for our clients. So education, and not just on the status quo.
Yep.
To employers, I would say, get involved. You are the single biggest payer of health care outside of government health care. You, Mr. and Mrs. Employer, are still paying the bulk of the insurance premium in most situations. And as you said, health insurance does tend to be the number 2 largest item on the P&L, and it's the fastest growing, and it's outpacing the top line. Employers can't possibly keep up with the growth of their cost. They have to shift more costs and raise deductibles. There is no other thing they can do unless we can find a way to lower the cost. So, make sure to the employers that you are challenging your brokers and be involved. Manage that item on your P&L like you would anything else. And that doesn't just mean shop it out to the 4 insurance companies every year or have your broker do it, but break the model with your broker.
Yep.
Partner with your broker and say, look, there's got to be a better way. What are the options that are out there?
Yeah, to your point, you just triggered a thought, and then we'll close there. Is health insurance is one of the few products I can think of in this country that gets worse as it gets more expensive. And you just described what's happening for most employers. They're the biggest lever in our industry for change. 100 million plus people get their insurance or health plan through their employer. And so they have the ability to also change what we're just discussing as well. And so I hope they listen to you. I hope your counterparts in the consultant world listen to you as well, to lean in and to learn. John, it's been great, man. I really appreciate you coming down. It's been a pleasure. So thanks for lending your voice to the show.
Thank you.